Happy Thursday to you. We welcome all of you here as we talk about trading the trend or the lack thereof in some of these areas like software. So that software area has been brutal up into this point, and it's just tacking on more here today, and also on some other tech stocks as well. We'll talk about that, how that's kind of dragging down some of the other positions, but some being more resilient. We'll talk about that. Now, in this class, we'll talk about past examples. We'll talk about current examples. We'd like to welcome all of you here today. This is a live recording. And also, if you're watching this on the archive, hello to you. Now, just real quick, we have Connie Hill in the chat. We welcome her as well. You'll see her initials as CH. You can follow Connie or myself on X. Join us there. I did also post on X earlier this morning, probably about 10 Eastern, that I was going to be out tomorrow, Friday. I'll be out, so Monday is President's Day, so market is closed. I'll be out Tuesday. I swear on my life, within an hour of actually putting that out there, market goes down again. I think that's 4 for 4. So if the market is bearish while I'm gone, we've successfully been 4 for 4 when JV is gone for some reason. And we're just, it's odd. Market goes down, okay? I didn't take a vacation more than 4 days in a row for 18 months. And then last April, the market goes down a lot, okay? I don't know what it is. I don't think I'm going to tell the market I'm gone next time. I don't know what's going on. So just real quick, we'll hop right in. Now, remember with what we discussed here today, we'll talk about stocks and options. When we bring up our examples, remember that options carry a different degree of risk, and are not suitable really for all investors. You get to decide if that's something you would consider, or what type of options, if you would consider any. Now, also remember the information is provided for general informational purposes only. Schwab does not recommend the use of technical analysis as the sole means of research. Yeah, I'm thinking about going back on X and just canceling that post. Maybe that's what I should do. But paid money software is for educational purposes only. That's where we're going to show our examples. Investing involves risk, including loss of principal. Could be even unrealized gains where the market falls down or the price falls down on whatever ticker you're using, and you give back those gains. That's the most hurtful, okay? At least it feels like that. And also remember when we talk about examples of, let's say, futures, we're just looking at the tickers. We're not trading the futures. We're looking at the prices, which then might reflect into, let's say, sectors, industry groups, markets, and or stocks. Now, we'll talk about kind of where the markets are this morning. We'll talk about how that's translating to the paid money account, anything that we need to be made aware of. Going to be talking about kind of managing the position in terms of A, stop adjustment, 2, entering of, let's say, protected positions, or adding protected positions as well. And then we'll talk about some new examples. Now, let's go ahead and hop right in. First off, when you pull up a dadgum list, the last thing you want to see on the very top is the VIX, okay? That's the last thing. You're like, oh my gosh, we've seen this before, okay? Now, the one thing is the volatility with a lot of earnings. In the last, let's say, January 19th till now, almost about a month, has kind of been choppier on the VIX. We've had some times where we got above 20. It didn't last very long, but when those spikes go up, you feel them. Drops back down, we like that. Runs back up, don't like that, unless we're talking about trying to buy something. And then all of a sudden it drops back down. So there's definitely been some higher volatility in the market. Now remember, VIX at 16 usually is translated to the S&P 500 is moving approximately 1%. That's the range. So anything north of above 16, that range is starting to increase. Now, you take a look at, let's say, things like the SPX. Did it really break out of a trend? I can't say that, but it has come down back in the middle of the range, okay? The SPX EW, if we pull this up, okay, EW, equal weight, that was a brand new high here today, and then it sold off, okay, the equal weight. We'll come to the sectors in just a moment. When we look at areas, let's say the NASDAQ, let's go Dow first. Dow, not a brand new high, that was 2 days ago. It's back down to the breakout level. Not completely unusual, okay? So the SPX Dow, not horrible, but not super bullish either, at least on the SPX. The NASDAQ itself, we know that's been the area that's just been rough, okay? We'll show some of those tech stocks in just a moment. that have literally been treated like the enemy deserves no mercy. And some of those tech stocks, there has been no mercy on the selling pressure. Now, when you look at the NDX, the SOX really underneath that was a brand new high this morning. We're talking just a couple hours ago, okay? And that really actually showing a V pattern. Now, is it all lost for the semis? I can't say that. But you're going to see that the dadgum softwares, those hardwares, not helping that space out at all. Lone Rangers and semiconductors, Micron, WDX, WDC, Seagate Technology, etc. Some of them are holding up, but definitely being drugged down. And the last but not least, the Russell. Russell unable to actually make a brand new high, yanking back. That's the key word, yanking back, right back down to that prior low area. So when we see actually the ZT, the 2-year, the 5-year, the 10-year, the 30-year, that they're all increasing in price, that tells us yields are dropping. Now, again, if those yields are dropping, those interest rate sensitive areas like utilities, might benefit from that. In other words, those who invest in fixed income might say, hey, I'm not getting as much in terms of the rate. I might actually try to take something that has the same dividend, which is speculative, okay? But also might have price action. Some of those utility ones, as the rates have fallen, have pushed. By the way, if you look at let's say the staples, those are brand new highs. So again, remember, think both sides, right? You got one area that's growth, and the middle is value, and the other side is income. If people are actually in this side growth just getting pushed down, 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 it doesn't mean they completely liquidate. Repeat that. It does not mean they completely liquidate, but they're changing what they're buying. Now, some of those people get drugged into value, drugged into income, just because, hey, it's not as volatile or hasn't been or currently showing a trend. Doesn't mean they're always going to be there. They might want to say, look, as soon as those growth are showing some stronger footing, I'll get back in. But right now, it's been a dadgum struggle in those growth areas. That's not new. Just the selling is actually kind of worsened, if you will. The real estate did actually poke its nose above a, 9-month high? That was a brand new high. And many of these actually real estate stocks have had actually a decent push here today after they hadn't done a whole lot for a long time. So the interest rate areas, trading correlation, it's kind of been working out better than just being in growth areas. Now this, when we talk about trading the trend, we don't lock on to any one sector. If you were to ask us what is our favorite sector, the ones that are going up or not down as much, that's the favorite, meaning that we don't fall in love with any of them. What are you doing for me lately is what it's called. Now, super quick on the, if we talk about, let's say, just prices, very quick, and we're going to look at the paid money portfolio. Gold, not yet. Silver, as we kind of said, it had more work to do. We didn't even get up as close. So we haven't seen a breakout in gold and silver yet. Last night, it got pretty close for a closing price yesterday for gold got pretty close. But even some of that volatility coming into the gold price space as well. Now, where we are kind of seeing some selling pressure, transports. Depends. Now, by the way, I'm using you could use a different ticker. I'm using $DJT. You see a steady press down in the transport space. The industrials here, you're going to see that kind of looks like it has a Lisa Jack type candlestick. What is a Lisa Jack type candlestick? It's the unfavorite Lisa Jack candlestick where there's an upper shadow. Usually that actually means that we could have actually hit the top in the shorter term. Buyers or holders beware, we could be trying to pull back. All right, so this is nice and dandy, but let's kind of just show just one more sector and talk about some positions. Those financials, commercial, that had been under pressure, that pressure just continued. The crossover happened yesterday. The intraday move happened to the 10-period moving average, couldn't get above it, and actually just pushed down. So some financials also in the house of pain, not pleasure. Now let's kind of talk about how this is actually affecting the paid money portfolio. Let's go to just real quick the monitor tab. And so we just said financials. Let's just kind of talk about one real quick. So we got 100 shares of Wells Fargo, WFC. You sold the call, the 95 call at, let's say, 219. This is your classic covered call. Were these put on at the same time? They were not. Shares were purchased on the 20th And actually on the 5th of February, about a week ago, we sold that call for 219. Would you consider doing anything different here? Now, you got to remember something. When we take a look at this position, the nice thing about a covered call, you get a credit. Bad thing about a covered call, well, it caps the upside, which you might be okay with that. The second thing that's actually not necessarily great is if the stock actually goes down, the delta becomes higher and higher and higher. So if we had 100 shares of stock, sold the call when the delta was 40, negative 40, the delta was 60. Stock goes down, the delta of the stock's not changing, but the delta of the call is. If the stock goes down further and further and further below the short call strike, the delta of the overall position becomes bigger. Now, I think many investors might say, James, in this given situation where in 1 week, that call, for example, went up 70%, option number one, now, by the way, had the paper money account not sold the call, this would actually be a bigger losing position. Learning lesson number one. Options are not all about speculation. Sometimes it's more about protection and income. Now, I'm going to right click on this, and what I'm going to do is I'm going to buy that back. Now, if we take a look at this, we're going to buy it back because we got about 70% of the maximum gain. I'm going to try to buy it back for 66 cents. Just because we put our order in doesn't mean it's going to fill. I'm going to confirm and send that. Notice the commission there. If that's okay, I'm going to send that. Now, wait. If I get rid of that call, what does it leave us with? Answer, it leaves us with the shares by itself. Now, you go back to the chart just real quick and say, man, this is tough. Does this look like a bullish position to you? Many investors would say, there's no way I think that's actually bullish. Now, I'm going to play the role of the investors trying to stay in the stock position, but they're saying, I don't like the trend. Now, I'm going to kind of show you something a little bit. When we actually sell the call, now we're not going 20 February because those only have 8 days. Again, think back to your plan. So when that stock is below that 10-period moving average, I think that if I put one arm up and someone is trying to hit me, well, it's going to be harder to hit me. But if I put that one hand is a short call. That other hand right there, that is a long put position. Now, if you're trying to hit me, right, I'm just going to kind of use my arms to kind of block me. And me is the stock position. So I'm going to go back to this, the 20 February. No, 20 March. And if I actually take a look at this, I'm going to actually go down to the 9th. Now, I'll look at this. If we sold the 87.5, that has a little bit higher delta. Now, why might one want a little higher delta? Well, they want it to be a little bit more protective, bigger credit. Con, you actually agreed to sell those shares slightly lower than what you bought the stock for. Okay. Now, let's say the investor said, well, James, I don't want to cap myself out here, but I am willing to actually, let's kind of go back and look at that 90 for just a second. If we do the 90, the delta's 35, you get about $1.87. Okay, sure. So, but the thing is, if you go look at the puts, you're going to see in this case is that these puts, the first out of the money, 42, second out of the money put is really 82.5. What side of the trade are we really concerned about? Answer, simple answer, we're concerned about the put side. Why the put? Because if we buy the put, it gives us the right to sell. We want to define the risk. So when things are going down, we're trying to put a floor on the position. Do you understand that? A floor. So that way, if it goes way below the floor of that strike price, it doesn't matter. We can exercise the put. Who controls that right? The buyer. Now, we're going to actually sell the 87.5, and then we're going to buy the 82.5. Okay. And when we do that, sell the 87.5, buy the 82.5. Now, what this is going to do is when we put that right there, this is going to take the position from a covered call to a collar. So the only thing we're tacking on here is just adding on that put. We're putting a floor in. So if the market becomes more and more volatile, and maybe I'm not even here, which is not true. I'm always here. Okay, I'm always here, even when I'm gone. The big thing in this case is, well, it can't be that bad. Okay, the floor. Now, do you get a credit? You do. Why? Well, because you're selling the call. You're selling the call close. The stock is closer to the call, so a bigger premium. and the put is a little bit farther out of the money. That's why it's leaving you with a credit. So the cap to the upside is 87.5 plus 91 cents. You want to get real technical, minus the commission as well. Okay, there it is. Now what we're going to do in this case is send the order, and there it is. So now if this actually goes down, what's the delta? The delta is 22. What is the delta actually telling us? Stock goes down $1, we're going to be down about $22. Stock goes down $2, it's going to be down about $22 more. Not 100. Why? Well, because remember the hands? Put the hands up. Okay? Now, a couple times in my life, I've had to be in fights. I mean, they told me I had to fight. Didn't want to fight, just told me I had to. And sometimes the market, that's what it feels like. Okay? Now, here's the deal. Let's go back to a stock position where you say, look, James, I don't have 100 shares. And sometimes that's going to be the case that you don't have 100 shares and you're thinking about, am I seeing sell signals? Now, as people, we're very good about not internalizing what we don't want to internalize. That's not great if you're managing a portfolio. You want to actually internalize even the crummy parts of technical analysis. What do I mean by that? Well, let's say, for example, given. And by the way, if the investor doesn't manage this, or at least kind of improve upon this, you're going to have bigger losses than your winners. You're going to sell when you have gains and it make you feel good. The problem is you're going to cut them short, and then you never actually get rid of the losers, and you tend to just kind of be spinning to the land of nowhere. You're trying to get rid of the ones that are not, especially if I'm going to imagine that, let's say I decided that as an investor, I don't want to do options. So I'm going to use exits on stocks. Now, we have talked about deliberately, if we're trend trading or swing trading, what might be some exits on stock positions? Well, we've been very explicit talking about, well, one strike would actually be that the 10-period moving average goes red. We have a red background on CCL with a 1. Red background meaning red moving average, 1 representing the number of days the moving average has been red. So we got strike 1 actually on CCL, which isn't surprising considering if you look at transports. The other thing that we're actually seeing on ST, right, 2, okay, is the whole moving average. Well, the whole moving average, if you take a look at that, that's actually red. Now remember, there's only 3 strikes here, okay? Now remember, 3 strikes, it doesn't like you. 2 strikes, it doesn't like you again. 3 strikes, it's just confirmation, it doesn't like you even more, okay? So the only thing that we're actually lagging here is if that 20-period moving average really goes red, that is where you're waiting to the last sign of confirmation. Now, we got 2 strikes here. Remember what we said before. We're not going to sell in the first one per se. That's the early indication. But if we get 2 strikes, which we have, we're going to go in here and just sell that position. Now, scripts are not guaranteed for accuracy or timing, so we want to verify this with what? Our own 2 eyes. Now, but James, I had a bigger gain before today. Yeah, it's what happens. At the very end, you get a nice little trend, and then bang, it just drops. I know it's sad. Sometimes it happens like that. Now, if you take a look at this, what you're now going to notice is let's confirm that what we saw on the market page is what we're seeing on the charts. Are we below the 10-period moving average? That is correct. 2, have we had a crossover? Yes. Now, if we kind of said what was the place to enter, we might say, well, right there. And if we flip that and actually said what might be a place to sell, it's right here. Okay, now, if we're talking about step 2, now remember, what is step 1? Step 1 is when the moving average goes green or the moving average goes red, depending if you're bullish or bearish. Step 2 is actually, let's say, example, give a moving average crossover, 10 above the 20 or 10 below the 20. I mean, it doesn't get any simpler than that. I mean, so it's not waiting for the lagging 20-period moving average to finally go green, okay? So now here's the deal. You could see it, but the question is, did you sell the position in your paid money account? So you want to kind of almost in your mind treat this like a job, like my job is to trade the plan. Whether they're gains or losses, of course there's going to be gains or losses, but the goal that I'm trying to go towards is not gain or losses, it's following the plan that I've seen set up to actually, the investors actually seem to set up, that they say, that's how I want to trade the strategy over time. So I'm going to come up here, drag this stop right there, right to here. And what I'm going to do is I'm just going to stop it out. Now, when I do that, if we had that target as well, if we get hit out on the stop, it's going to cancel the target. Okay, now comment was from James L. 561. The exit was yesterday. Gosh, James, just stop rubbing it in. Okay, you could say the exit was yesterday. Yes, but we didn't talk about it yesterday. So we do see that there. Now, I'm going to take one more, okay? Now, let's kind of say on this, if I went to, let's say, example given, Oxy, okay? And I need to actually address really Oxy and PM. Now, if we looked at Oxy, let's show this on a different view. So if I look, oh my gosh. So why did I give that react? Oh my gosh. Why did I do that? So when I show you just this by itself, what are you noticing? How far did we get away from the target? The answer is we were 20 cents away from the target. What does that mean? Well, if we do a 1-to-1 reward risk stop methodology, the stop would have been 20 cents below that high, irregardless if you were there or not. Now, since the paper money account didn't do that, because it wasn't trading the paper money account, what you're now going to see is the stock has gone down $2.75 on 150 shares. I mean, talk about just putting salt in the wound here. 150 shares, stock went down $2.75, and that lack of not kind of stop adjustment, that was only on this position, $412 mistake. You see how it kind of adds up? Okay. Do you understand why I said the reward risk methodology, like 1-to-1, 1-to-1.5? Why? Because when you go so close to the target, you're not saying I'm gonna set my stop like at the 10-day low. You're gonna have a way bigger risk than reward. Does everyone understand that? So in this one situation by itself, it was a $412 mistake. So when things start pulling back, if the investor has not done the routine, okay, it can become thousands of dollars of mistakes based upon not following a plan. Now, if you got a big portfolio, it could be tens of thousands. You got a big portfolio, it could be hundreds of thousands. Okay, I mean, who's counting? Now, I'm going to bring this up if we recognize. Now, James, why didn't you sell it earlier today? Because we do all the trades in class. We do the adjustments in class, right? I'm going to actually bring this up, go stop, send. Now, if I go back and look at that position, I'm left with $53, enough money to buy a Diet Pepsi and try to make myself feel better. It ain't going to help me feel better because really that gain would have been about $500 instead of $50. Okay, I got enough money to buy maybe a cold beverage 12-ounce can and maybe a box of Kleenex so I could actually just wipe my eyes with tears. Okay, so I just tell you, follow the routine that we talked about, which we talked about in the trend trade plan and the swing trade plan. Now, I do have to come back down to this one right here, the PM. Now, PM is a little unusual because we have the stock position, we still have it, and those are when it was purchased. But what we had on that was we had a collar in place. You guys remember that? You remember, right? We put on the collar, we went over the earnings, we said, look, we just want to make sure that we're not going to just give a lot of the capital back. So we put on the collar on the 5th, and you can see it right there, the 5th. Now, yesterday, that collar was actually, it was purchased back or exited. Now, we got in for a 60-cent credit, and we actually paid $4.16 to get out. Okay, so you got a 60-cent credit, what, $4.16 debit? My math is good right there, $3.50 difference. So we lost about $3.50 on the option difference, but where are the gains? Are there any? That's on the options, but the gains are in the stock. So if you go look at, let's say, the stock price and say, what has the stock done? It poked its way through the resistance. That exit of the collar, the protection, remember putting our hands up? We decided we were going to put the hands down because, well, the stock wasn't getting hit, okay? And we said, look, get out of the collar if it breaks resistance. 186.85, get out of the collar. You get out of the collar, it only leaves you with the shares. Now, so far, it's actually held in there. Okay, so that one's worked out. Now, here's the thing that we would probably say, just being a realist. The more that the market falls down, the greater the chance that positions like this might get drugged down. I mean, that's just being real, okay? So, I mean, the stock is not immune to what happens at the stock market. Does that make sense? Now, the other comment came in. So let's go into just real quick a couple of examples, okay? So first off, I want to bring up the example given. There was this comment. You know, you have days where all of a sudden you see some big stocks down as well. If they're down, you want them to drop down, but not have gap down risk. It's the gap downs. That's more damaging than if you actually said, hey, the stock just opened down and went down. The worst ones are like Cisco, meaning on Cisco itself, you see it closes at 85 and it opens up down below 80. And so if you said, James, I had my stop at 84, you're not going to get filled at 84 typically. You're going to get filled down probably here or lower, okay? Most likely there's a gap. Now, we could talk about that example. There is a position on it. What's the position? 100 shares of stock. And you're going to see the only thing that's actually kind of kept this alive and maybe not worse down here is actually the collar position. Still, though, down 120. That had been a collar position over about the last 10 days or so. Had it not been for the collar, I mean, think about this. If the investor went over the earnings with shares only, you're down 560. But with a collar example, over the earnings, down 117. Now, I don't think anyone wants to be down at all, but if you had to choose one of them, I'll probably take the 118, okay? Now, let's talk about another earnings example. And this is another example where sometimes companies can come out with decent earnings, but the stock doesn't react very well, or there are investors, okay? Now, I'm going to kind of paint a picture for you, okay? I want you to imagine that you walk into an open field. Grass, maybe foot and a half, 2 feet tall, okay? And you're looking on the edge of the woods in this opening, and you just can't see anyone, okay? Now, as soon as they announce earnings, I'm out walking in just a wide open spot, okay? And along the woods edge of this open meadow, I don't know who wants to sell. As soon as they announce earnings, or maybe after, all of a sudden I'm like, wow, I realize I'm not the only one here. There's some sellers here. They want to knock the price down. The example that we're going to look at here is AMAT. You got earnings coming up just today. Now, we know that in the bearish toolbox, option number 1, short call vertical. Probability trade, smaller income, it's a credit, but it doesn't have as big as upside as a long put vertical, a debit, bigger maximum gain, reward and risk typically about the same. If the investor said, I'm going to buy the put on the earnings date, volatility is high, break even is lower, could actually have a bigger max gain, but the break even needs to go lower. Okay, the stock needs to go lower to the break even because hence the bigger premium. Short call, you could do a short synthetic, right? Call vertical with a long put, or flat out just short the stock, period. Short the stock, more dangerous, can't even do it in some positions, accounts, because you can't be short in an IRA, okay? Short stock, that is. Now, what I'm going to do is in this example, one of the interesting things about verticals is you're selling something and buying something. So if you're buying a put when volatility is high, well, you paid more for it, but the credit the short call should also be more as well. Let me say that. If we buy a put when the volatility is higher, the premium is going to be more. If we sell the put, let me fix that. So we're going to do a long put vertical. So if we sell the put, the credit should be bigger given the higher volatility. Now, why are we choosing a long put vertical? Well, we kind of want a trade that might have bigger potential upside. Okay. Now, if you said, no, I don't want to do that, I actually want to kind of have a higher break even, then that investor is really being a little bit more conservative. Conservative doesn't mean bad. Now, first thing what we want to do in this case is we need to notice something here. You got a 64 implied volatility. And what you're now going to notice in this case, those spreads are $1.35 wide, and those right there are about $1.60 wide. Now, I'm going to show you something. I had wanted to do a long put vertical, but as the day has gone on, this has actually gotten worse and worse and worse and worse in terms of the spread. If we went down to these, we'd almost have to go down to these, okay? Farther out of the money, if you will, or below, to really get to where the spread is narrower. So we have a more volatile market and earnings that's widening out the spreads. Now, could we look at the stock and we say even the stock has about 35 cents? So in this example, you know, if we were trying to push it, we would say, I'm going to do, let's say, a long put vertical, but the spreads are wide. If someone said, James, I'm okay with being short the stock, I do not want to be in something where the spreads are that wide, they might just say, I'm going to short the stock. Now, based upon looking at this now, the spread being that wide, that's not consistent with any investment plan we talked about, where we said spreads, looking for spreads of $1.35 wide. No. So this is why we have different strategies. Sometimes when you go look to actually apply a strategy, you say, I like to do that, but the liquidity's not there. Or the spread is too wide. We're going to right click on this bid. We're going to sell custom. And what I'm going to do now is go with OCO bracket. Now, wait. If you go up to the very tip top, underline, right click on the bid, sell custom, and now go with OCO bracket. This is really, if you look at it, this is it's the most risky trade. Now, higher risk, where's the risk coming from? Well, if we come in here and say, I'm going to sell 25 shares of stock, the risk is coming from that if you sell 25 shares of stock, the risk is that the stock could go up to infinity. That's the textbook answer. I've personally never seen the stock go up to infinity, but I've seen the stock go up a lot. Now, the big thing is if we talk about, let's say, the stop, we're saying in this case, look, if it goes higher than X price, get me out of the position. So what I'm going to do on this is I'm going to say, look, at what point would I say, hey, look, this trade is not working out? I think if this went probably higher than 350, if we did 2% above 350, we're probably talking about 357. And if I actually typed in a number of 357, now notice this order, okay? We're saying stop data GTC, okay? Now in this stop, okay, what it's now doing is it's saying sell the stock at that price or lower, but then buy it back if it goes up. The loss is the difference per share times the number of shares, okay? Now, if the spread was narrower, we could probably do an option example. Trust me, we've got another example we can look at. Now, in terms of the buyback, the downside, okay? Now, by the way, this is a nice way if you're a stock investor, you say, James, I don't do options, but could I learn to do stocks bearish example given? Yeah, good. Now, what I'm going to do in this case is I'm going to kind of try to do some things here to try to help us potentially in a example of gaps, okay? So one of the risks of a buy stop is what if it gaps up to 357 and then fades off? I'm going to put in here that you're only able to buy up to 358. So if you gap up to 362, yes, the losses would be bigger, but I want to make sure it doesn't pop and then just fade. Does that make sense? Buy stop limit. So you're allowed to fill in that range right there, but no higher than 358. Don't want to see a gap and then it falls down. We took a bigger loss, right? Want to try to get that filled. The risk of this order is if it goes higher than 358, it doesn't come down, the loss is bigger. Second, if this stock actually goes down, we could say this bottom range, let's say 292, or we could actually say, well, wonder if you actually said, look, maybe 279. That 279, I'll put 280. We're saying if we fall down to 280, sell the shares. Okay? Now, this is a little unusual because you're thinking, well, the trend has been up. There's decent expectation about what the stock is going to do based upon what investors have been willing to push the price up to. If it's not, the earnings are not as good, or it's not different than what they said, they might use the opportunity to sell. We don't know. We're about ready to find out. Now, I cannot do this in the IRA. It will reject it. Has to be done in the margin account. The other risk that we actually need to make mention on this is dividend risk as well. The company pays a dividend. Whoever borrowed those shares is they're the payer of the dividend. Okay, does it pay a dividend? Pull this up here a little bit. 46 cents a share. That's coming up on the 19th. Now, if this stock gaps down, we're not going to really get into that. Okay, unless we hold on to it for another week. Okay, but we did check that. It's not a massive yield or anything like that. We're going to confirm send. This is a stock bearish trade. Now, you need to understand this because back when the markets went down in 01 and 02, 07, 08, different times, there's times where stocks, they go down. Now, I'm going to fast fire just for 60 seconds a couple stocks that have been severely under pressure, okay? So example given, if you look at stocks like PayPal, my gosh, I mean, where's this going, okay? The best thing you could say is maybe 0 is a floor, which is not a great support level. If we look at stocks like Netflix, I mean, where's that going, okay? Fresh new low for it. Now, the other one is if I pull this up, even if you looked at a stock example given like Dash, fresh new low, you look at Palantir, I mean, some of these tech stocks, fresh new lows. This is the opposite of what we're talking about when the stock goes up for, let's say, remember in bullish, we like to see stocks pull back less than 3 red candles, okay? Well, what happens if the moving averages are red, not green? And the up days don't tend to be longer than 3 green candles before you see selling candles again. Just the opposite, but just in the bearish trend. Now, if I bring up, let's say, just for a quick Thomson Reuters, okay? Now, Thomson Reuters, if you look at this, it's been in a fall down and now it's sitting here. Now, I like to think about this when we talk about flags, right? You kind of come down and you come back up, meaning there's some type of bounce back. But in this case where it drops down and it almost kind of goes sideways like this, okay? This is kind of more like a hockey stick formation where there is no bounce back, okay? And so which one is more bearish? Many investors might say if you see a price pattern that kind of looks more like a hockey stick and there's no bounce back up, I mean, it gaps down to here, and what was the bounce back? The answer is not very much, under immediate pressure. Went up for 1 day, went up for 2 days, and then sell, just pounding the stock down. And this is what I'm kind of saying is sometimes when you look at the moving averages, red and the red shading, the investor that holds the position or looking to buy, they're walking out into a field, and they got this bad feeling that they're not the only ones that are there. And those sellers are on the edge of the woods looking for anyone who's trying to buy. And if they could get buyers to buy, it gives them liquidity to try to sell more at a higher price quickly. If I look at TRI and if I looked at this, you're going to see that this is also something with a pretty wide. And I think this is kind of what we're just seeing right now in terms of actually spreads with the VIX being higher, etc. That's a pretty wide spread. So sometimes it's not an option all the time. But TRI, some of these, this is why some people like to short stocks when the volatility is higher. But those are not the only ones. Last ones, Adobe under severe pressure. I mean, where's Adobe going? CRM, Salesforce, massive pressure. Intuit software, I think QuickBooks, Quicken, things like that. Where's that going? Another ones that are actually under severe pressure. Workday, Paychecks, and also ADP. These are ones, again, related to software. When I kind of said that there's some pockets of the market that are under severe pressure, oh man, I mean, just think these stocks, okay? Now, I want to kind of make mention of some of these other ones that might be holding up a little bit more. Now, we know that VZ, they've actually had some pretty big pushes. When you look at a stock like T-Mobile, they're in that cellular space. Why do people kind of like the T-Mobile, TVZ? Well, when you look at these, a lot of these companies actually pay out dividends. When you look at T, they actually have a dividend yield of 3.84%. VZ, well, it's 5.69. Okay. Now, that doesn't mean they give it the dividend today, but they might look, if some of these companies are going, having the dividends paid this month, they might try to buy the stock ahead of the ex-dividend and try to get in and try to have something that might have lower volatility. With that in mind, now the T-Mobile does not pay the same amount in dividend. It doesn't. When does it pay a dividend? If it does. The ex-dividend is really 227. So it's coming up in about 15 days here. It's not as big as T and Verizon. We're going to look and see, can we actually buy shares of T-Mobile here? Buy custom. Now, I want to go back to something. We've had a pretty good push here in the last day or so. And you're going to notice I'm just using our ruler, okay? Now, our ruler here, remember, the light blue line is the 10-period moving average. Yellow is 3% above. Red, 5% above. White, 7% above. I put on the blue because I was looking at NXPI this morning. That's 10% above. And remember, the higher you go above the white line, the light blue line, which is the 10-day exponential, you have a greater statistical chances of pulling back. Now, remember, when we're talking about buying something, in our examples, we're trying to show examples of maybe trying to buy in between the 10 and that yellow line, 3% range, red. So in this example, what I'm going to do is I'm going to right click, okay, right at the at that red line. If I right click it, go buy custom with OCO bracket, this is stopping us from just getting in sometimes too high. Example given, if you looked at this morning, NXPI, even if you said, I love it, I love it, I love it, I love it. You're really north of the white line, right? And if you even would have tacked on that 10%, you realize if I buy higher than that white line or even the red line, greater chances that shorter term profit takers start to actually profit take. Now, let's finish this. T-Mobile, if we look at that support area, if I even set the stop below that 202, 202.31, less 2%, 198.26. Giving some room there. And if we go data GTC, and then if we said, well, what about that target? Well, if we're talking kind of target areas, probably right around the range of about 230, kind of really being the horizontal resistance area. I got to wrap it up here, but so the one thing is the comment that was made before, cash is a position. Well, cash is just saying, look, I've sold some positions and I'm waiting for some new setups. Understand. And so sometimes you do have some cash based upon market conditions, what is done in the market and or stocks. Second, there are some setups, but you might not see a ton of setups. You're just waiting for those setups that you really like to see. These are more income, lower correlation, lower volatility type trades. Now, I'm out of my time here today. We've got short verticals coming up next. Thanks to Connie Hill for answering those questions in chat. I'll see you back next Wednesday. I will be here in spirit. Trust me, I'm never gone. Okay, I'm always watching. And don't think when I come back I haven't been watching. So I'll change that to GTC. Now remember, with what we discussed here today, we did a heavy dose on portfolio management, adjusting positions. We talked about kind of euphoria, maybe watching those envelopes and not buying too high and being aware of where it is too high for some investors. Also remember that some investors might want to practice bearish trades. to dilute or alter the portfolio to be not as bullish. Now, remember with what we talked about, all investing has risk. We talk about trading the trend in terms of from a bullish sense, but also maybe a bearish sense as well on some certain names. Stay tuned for our next webcast coming up next, and don't forget to subscribe. Take care. Bye-bye.